Good evening, ladies and gentlemen, and welcome to Part 5 of our Power Options for RadioActive Traders series. Tonight's presentation is the open discussion, Q&A. Essentially, this is the end of the planned educational material we have for this particular series. There will, of course, be other webinars down the road. We'll do other evening webinars down the road, different time frames, focusing not only on the radioactive trading techniques, but also on other strategies and the Power Options tools as well. Regarding this particular Power Options for Radioactive Traders series, excuse me, we may even do one more presentation, one more follow-up, depending on how the questions go tonight. If it seems to me that the questions are based on one, or focused, I should say, on one particular aspect or one particular feature of Power Options or radioactive trading, we might have an additional Part 6 webinar that addresses just those issues, so we can make sure that we cover all the bases and make sure everyone is comfortable, everyone is clear with how to use the Power Options tools and some of the concepts of radioactive trading that are in the blueprint as well. Also, we might plan in the future, I might do a presentation that's sort of a summary of these 6 parts, where 15 minutes is just devoted to each one of the individual parts. Part 1, of course, was using the search tool. Part 2 was an open discussion on the search tool. Part 3 was research and analysis once you've identified radioactive profit machines from the search tool. And Part 4, of course, was using the portfolio tools to track, manage, and review potential income methods on the radioactive profit machines to help with your SIGA model. But we'll discover if we need to do that today based on the questions that you have and what comes up in tonight's presentation. All right, let's go ahead and get started here. First, just to review, what is radioactive trading? Of course, most of you are familiar at this point, but radioactive trading was developed by Kurt Frankenberg. It's a limited risk approach to trading and investing. With the radioactive trading techniques, we use put options as guaranteed protection on our long stock positions, not a speculation, just buying a put, for example, and speculating the market's going to fall one direction or the other. The setup allows us to have limited risk positions with an unlimited upside profit potential when the position is open. After that initial position is open, based on how the stock moves, then we have 10 different income methods that can be applied to lower the risk, bulletproof the positions. And when we say bulletproof, we mean that the guaranteed exit that we have on the position, the strike price of the put option, is actually higher than our cost basis into the position, and of course earn extra profit with those 10 different income methods. Kurt Frankenberg developed these techniques about 9-10 years ago. After he had lost all of his money following his guru's advice, he'd paid a couple $1,000s to attend a weekend seminar to learn how to trade covered calls and calendar spreads, and after a few months and following the guru's advice, he ended up losing all his money that he had set aside for trading. But he didn't give up. He kept researching and analyzing the markets and developed this technique, which he's been trading in his account, and I've been trading for about 2.5, almost 3 years now. It'll be 3 years in the next 2 months. Now, Power Options is a patented suite of search and analysis tools. We've been in business for over 13 years. These tools are designed for self-directed options investors. We support over 23 different strategies. In each strategy, we have tools that allow you to search the universe of options in mere seconds to identify only those positions that match your personal risk-reward tolerance. Once you've identified the positions, you can then quickly compare the risk versus reward, analyze the position, further research the position, for example, and run what-if scenarios. That was essentially covered in Part 3 of our Power Options for Radioactive Trading series. We also have a powerful set of portfolio tools to help you paper trade, track, and manage your positions, and also to analyze potential adjustments or rollout opportunities. In the case of radioactive trading, Kurt refers to them as income methods. That was Part 4 of our series here on Power Options for Radioactive Trades. And we also offer, of course, countless educational articles and help pages on the Power Options suite of tools. And my name is Michael Chupka. I'll be your presenter for this evening, as I have been through the course of this educational series. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie and Greg Zarenner for the past 8 years and the staff at Power Options. I handle a lot of the coaching sessions. Anyone who's on a free trial or a subscriber to Power Options can sign up for as many coaching sessions as you like. They're completely free. We never charge for them. There's no limit to how many you can have. The coaching session is essentially a 40 to 50-minute phone conversation, usually with myself. I'll answer any questions you have on the tools and Power Options, walk you through the site, and help you with any kind of the setups you're looking to create, or if you're tracking any of the positions, what are you kind of looking at when you go through the evaluation of the income methods. And I am versed in all strategies on the site, and as I mentioned, I've been trading radioactively for almost 3 years now. Now, what are we covering tonight? Well, tonight's presentation is your questions and your concerns. Feel free to ask any question regarding the PowerOptions tools, about using the search tool to set up your search for radioactive profit machines, the steps for researching and analyzing those positions once you've identified them. If you have any questions about the portfolio tools or tracking the positions in the portfolio tool, or analyzing what-if scenarios as you're tracking a position in the portfolio tool, or the SIGA models for the adjustments. And also, feel free to ask any questions regarding radioactive trading. If you have any questions about how it compares to other strategies, I can answer that as best as I can personally. If you have any questions about synthetics, hey, would this work better if I did A, B, or C instead of the standard setup? What about entering the position in this fashion instead of how it's described in the blueprint? I can try to answer that as well. Of course, I cannot give away the entire blueprint. Now, in those last two discussions, I said I can answer them as best I can. I can answer them based on my philosophies of investing, my philosophies of trading. We can use the PowerOptions tools to show some examples of, okay, if you opened a married put described by the blueprint, this is what you would look like. And if you decided to do a synthetic, this is what it would look like. Now, why don't I do the synthetic instead of the married put? I can answer that, but only you can really answer that for yourself. I can point out some of the pros and cons of both, but you're going to have to decide. I can't teach you how to trade for yourself, your personal goals, and your personal expectations. All right. Now, some of the processes and procedures for this evening. Again, use the question pod to ask as many questions as you want. We may not have time to go through all the questions, but we are going to try to go through them all. Of course, questions can be about the tools and PowerOptions with radioactive trading techniques. I do want to cover a few basic ground rules. We've never had a problem with this, but I always want to bring it up in the open discussion presentations. I just ask that we have respect for all the attendees and presenters. Negative behavior will not be tolerated, or consistent negative behavior. This includes me as well. Be patient. There may be several questions ahead of yours, but I am going to try to get through all of the questions, even if we end up going to 10:30 p.m. Eastern Time tonight, maybe to 10:45. I'm going to try to answer them as best I can, and I do promise you, if there's a question that comes up, I'll answer it to the best of my abilities. And if I feel that maybe you weren't satisfied with my answer, I'll jot your question down, and I'll have Kurt or Ernie answer that as well. And of course, I want to encourage you to feel free to help us help others. If I'm answering a question based on my experience with radioactive trading and using the PowerOptions tools, if your experience with the technique or something you've noticed on the tools is a little bit different and you have something to offer, use the question pod and send that to me, and I'll share it with the rest of the audience as well. Most important, let's have fun. No one's here to judge anything. I'm not here to tell you you should only trade this way. You should only trade this way if A plus B equals C and nothing else along those lines. We're here to have an open discussion. We're here to encourage discussion and participation. So let's have some fun and get some great education. All right, with that stated, let me navigate over to the PowerOptions suite of tools. I've already got some questions coming in, so let me go to the top of the list, and we'll start from there. Okay, Hal wants to know, when you have a stock stagnating, I'm in a married put position, the stock is not moving. Normally when we open the RPM, our expectation is the stock, let me just go over to the married put tools there, profit and loss chart here on the right. When I enter an RPM, I'm expecting the stock to move up. If the stock falls, I know I have a floor at the bottom, of course, but if it stagnates, what are we experiencing? Well, we're going to lose some time value on the put, and we're not gaining anything back on the stock. So Hal's question is, when you have a stock stagnating and the put value is decreasing, is there a point, like a percentage loss on the put, before you decide to do something else, like using another income method? Well, when a stock is stagnating, Hal, there are two approaches in the blueprint that you could possibly look to use. Income method number 8 is there's actually income method number 8A and 8B. This is the radioactive iron condor. Now, if you're trading in a restricted IRA account or restricted retirement account, you may not be able to implement that particular trade because it's adding a bull put credit spread at an income method number 1, or a bull put credit spread and a bear call spread. Bull put spread plus income method number 6, for example, are the two ways to do income method number 8. So you essentially create a condor on your position, and you want the stock to stay between the two strike prices after that's done, so that essentially, just very quickly, let me navigate over to the iron condor. Your married put will be turned into something like this, I believe. You look something like this for income method number 8B. That's the full iron condor. Now, as I mentioned, some of the reasons why this is not one of the most popular of income methods is because it does add to risk. Because when I'm doing a bull put credit spread on one side, that's not covered by the initial put that I have. When I do income method number 6, the bear call spread, the stock is covering the short call, and we have an extra long call position. So the difference in the strike price on the bull put side will add to your maximum risk on the RPM. Also, just because the stock's been stagnating doesn't mean it's going to continue to stagnate for the next 30 to 45 days. Excuse me. I've also found that doing an out-of-the-money income method number 6 trade may help in a stagnating position. And let me show you what I mean. Let's go to the portfolio tool. I'm going to go to the profit and loss portfolios. Perfect. And let's see here. Here's a good example. That's not a good example. Hold on. Here are two examples where things work differently, and I think part of the reason here why today's is a little bit different is because of the volatility there, Hal. What do I mean by that? In part 1 of our presentation, we ran the search, and we had 3 positions come up that I ended up putting in the portfolio: CarMax, Talisman Energy, and Valero. And the reason why I entered these 3 is because these were actually 3 RPMs, and I was considering trading in my personal accounts. We opened at the time on February 8th. CarMax could have been opened at $34.39 per share, and the July 37 strike put was priced at $4.50. So right now the stock has moved up 20 cents. We can call that stagnating if we want to, and the put has declined by about 20 cents as well. So we haven't really seen much of a decline in the put price. It's about even here at a 1-to-1 ratio. But in a normal situation, to be honest with you, Hal, I think we'd see a little bit different. What happened here, as you can see, the stock was down 110 today. This stock from when we opened it actually I think went up to 37 almost, and it's come down in the past 2 days. This means the implied volatility for the put option has spiked. Okay, so that's kind of moved up for us. But let's take a look at the profit and loss chart from the portfolio, and I'll show you what I can mean by income. Let's take a look at what I was talking about here for income method number 6 to be used in a stagnating market. As you know, it can be used in a bullish market. Kurt likes to use income method number 6, that bear call spread, when he's getting close to earnings. He's maybe expecting a gap in one direction or the other. So if the stock moves up, he hasn't limited his upside with income method number 6. But if the stock falls, then he gets to keep the premium. Now our original setup here, we had a 4.9% at risk, or $189, and of course the infinite maximum upside. And as we mentioned, the stock hasn't really moved, and we have seen a little bit of time decay on the position, about a 20-cent swap in both directions. Well, right now with the stock at $34.39, let's go ahead and go to View Options here, and let's just pull up March, for example. Now remember, whenever you're planning on doing any type of income method in this scenario, you want to make sure that you graph it so that you see what it looks like before you do it. Does this match your Sieg model? Because it's not only about what is happening right now. Those are the conditions and part of the Sieg model. What we also have to focus on is what are we expecting to happen next. So even though I have a 37 strike put, if I was just doing income method number 1, if I was just selling a call, I'd only do the 37 strike call or higher. I wouldn't want to sell the 36 call or the 35 call in this position, because I have the 37 put. But with doing an income method number 6, it's okay to sell a call that's below the put strike price. You don't want to go too deep. You don't want to go in the money when you sell that short call with income method number 6. You still want to be out of the money. But let's just run an example of selling the 36 call. So go ahead and click that. Show me that it's been added into block number 3 here of my setup. And instead of the 37 call, I'm going to use the 38 call for my upside. Okay, so there's a $2 difference in the strikes there. I'm going to sell the 36 call at the natural price of 45 and buy the 38 call at the natural ask of 20 cents. So let me just change my action here on this March 36 call to sell. I'll put in one contract, and I'll buy one contract. Now remember, our original at risk amount was 4.9%. We have the unlimited upside profit potential. By selling this, we'll generate only about 35 cents of premium. I'm sorry, 25 cents of premium. So that might be a little bit low for you. Again, that has to match your SIGA model as well. Now, we really only lowered our position by about our risk, by 4.3%. And that'll still happen on the downside. And what we're going to see right here, unfortunately this graph didn't expand all the way over to the right for me. The programmers are working on a way where you could click and drag on the graph. But what's going to happen here is that this is going to start to move back up. Now this isn't necessarily the best scenario. Again, the reason why is that premium is a little bit low. We're only going to generate 25 cents of income on this position right now. But it does give us a little bit of bump here. We sort of still have a maximum profit on the upside, and we can realize a relatively reasonable bump if the stock's trading right at 36. So again, what we have to ask ourselves here is that my position is stagnating. I'm trying to make up some of the loss in the time value by doing this income method number 6 setup here, which can be used in a stagnant market. But at the same time, we have the unlimited upside profit potential. But does this match our expectation going forward? What do we think is going to happen to our position in the next 24, 25 days to March expiration? If I'm expecting it to recover, and I'm expecting the market to recover from the recent volatility and turmoil we've seen due to geopolitical events and the increase in oil due to those effects, then if I'm expecting it to move up to 37 or maybe 37.50 over the next 20 or 25 days, that's my expectation. I probably don't want to jump into this right now. I'm going to wait to see that move and then consider applying another income method. Now again, let me erase those drawings there and let's scroll back up. Why wouldn't sell income method number 1 below the put strike price? Let me clear out the second call, which created the income method number 6, and leave the short call there at 45 cents. Now again, this is something you have to establish for yourself. I know why I don't do this, because it adds, see here, the maximum risk increased to 6.3%. Not on the downside, but on the upside. Because if the stock continues, if for whatever reason the stock now gaps up, this line is just moving straight down like this. So we have a higher risk on the upside. Now sure, the stock might need to be trading at $45, $50 per share to realize that 6.3 loss on the upside. But that's why I don't want to do it. If I wanted a 6.3% risk to begin with in one direction or the other, I might have done a lower strike put. I might have done the 36 put or the 35 put instead of the 37 to begin with. I didn't want to take on that high of a risk at the beginning. I didn't want to cap my upside gain here. And of course, the other problem is that if everything works out perfectly, the most I can make is 2.3%. Does that match my goals for the position? That's what you want to analyze. But when the stock is stagnating, the best income methods to use would be income method number 8 or income method number 6. All right, John wants to know, do we enter in all of our trades into PowerOptions manually? Well, in a sense, yes. Let's go back. Let me close down this window here. Let's go back to the portfolio tool. Now, if I wanted, there are two ways. We covered this in the first and third, I believe, presentations. There are several ways to enter in a position. For example, John, let's take this CarMax example, the July 37 put. Now, if I was in the search tool, if I go back into the married put menu and I go into the search tool, I only have 2 positions here. These are, of course, positions that I identified today. Naturally, if I want to place one of these trades on PWE or ASNA, once I enter the trade with my broker, I can enter the trade from here by simply clicking Add to Portfolio. This is a current position, of course. So when I click Add to Portfolio, this will take us, I'll have to click Insert here, so I'll put it into My Married Puts. No, I'm sorry, I apologize. I'll put it into PO for Radioactive Trading Part 4. And then when I select Insert, of course, this will take me to the entry page where I just have to put in my number of shares and my commission fees. The system's never going to know how many shares you actually traded or what your personal commission fees are. In the next rollout of the portfolio tools, there may be a selection where you'll be able to select your option and your stock commission costs, so that will always be entered for you. But right now, you just want to put in your commission fees manually. And once I submitted that trade, that would already be there. Now let's take the CarMax position, for example. We opened it on February 8th. We had that stock price of about $34.39, and I had a price of $4.30 on the put option, I believe, when we opened the position. Well, let me go to the Search by Symbol tool now in the Married Put menu, and I'll type in KMX. And to make things simple, I can start off with all months, but to make things simple, we were looking at July for that particular put, and I'll just select more results for now. Okay, so now we have the breakdown, and this is normally not the view you see. We selected something specific the last time we were running a scenario during one of the other presentations. So even though I entered this position on February 8th at different prices, I can still use that same feature, and I can go to Add to Portfolio, and I'll be prompted again to select my portfolio. If I've never created a portfolio before, I can just put in New Portfolio 1. Okay, but we'll do PO for Radioactive Trading Part 4. I won't put it all the way in, of course. All right, so we have CarMax, Let's say I did 100 shares, but my transaction date was February 8th. We knew the stock price was $34.39, and it was a paper trade, so my commissions were 0. Put's already selected for me, and again, I opened this on February 8th, one contract at a price of $4.30, I believe it was. Commission fee, of course, for 0. So then I can click Submit. So this is essentially a manual entry from an older position, but in order to select that, I could start with a Search by Symbol tool, so I had the right put already selected, and then I could just change my transaction date and fill in the prices. The system's never going to know your older prices or what prices you were filled on. Only you know that. Now, of course, if I'm just in the profit and loss portfolio, yes, if I have older positions and I want to just enter them manually once I get comfortable with the entry, I'll go ahead and click the drop-down menu, and I'll enter my strategy. I want to enter a married put. And let's say that, I don't know, on the 16th of February I opened an RPM or a married put position on Kraft. All right, so let me type in KFT, and I just did 100 shares. And so I'll change my transaction date to February 16th, commission fee of 0. And the price per share, let me take a stab in the dark here, $32.50. Now at the same time, I don't have any options selected, but if I click Select Option, it'll pull up a simple chain for me. And let's say I went ahead with the September put option. And with the stock at $32.50, I was able to buy the 34 put. And at the time, the 34 put was actually at $3.15. So I'll just click on the 34 put. Again, change my transaction date to the 16th, my number of shares, and I have to input my price at $3.15. So yeah, if you want to enter your older positions, you do have to do it manually. We don't right now have a way that if you have your positions in another format, a CSV file, an Excel spreadsheet, you can just copy them in. So you can take out a step by looking them up in the Search by Symbol tool and then linking to Add to Portfolio to adjust those positions and adjust it to your prices, or you can enter it manually using the drop-down menu. Okay, hold on one second. All right, sorry about that. Let me go to the next question here. Mark, I have difficulty following the portfolio math as it relates to the SIGA model taught in the blueprint. Can you review how to use it? Yes, I can review how I use it, and we're going to use the Talisman Energy position. First, to make things simple, I'm going to go ahead and delete the Kraft Foods position that I just entered, okay? Let me just delete the position. And while I'm thinking about it, I apologize. Let me go back one step, Mark. I might show this later in the presentation. Let me go back one step for John's question. When I was using the profit and loss chart earlier, that was the custom spread tool, of course. Let me just do this very quickly, Mark, and then I'll get to your question. So if I wanted to create a married put on Kraft based on my prices, I can go into the custom spread tool, type in Kraft, I can add in my stock. Let's do 100 shares and my price at $32.50. And then we can go into View Options, and we did the September series, 34. Okay, so I pulled up September, and I just clicked on the 34, and I bought one at $3.15. So essentially, I'm building the spread here in the Custom Spread tool, and of course, that would have been a 4.6% at risk, and you can just see the profit and loss chart. But up at the top now, any position that you create from scratch right in the Custom Spread menu, you have the choice here to add it to portfolio. And the portfolio will recognize that this is a married put, or if it's a collar spread from the beginning, you'll be able to input that as well. When you click Add to Portfolio, it will add all the available legs there. Okay, so that's one other way that you can do that quickly off of the fly. Okay, back to Mark's question. Now, the SIGA model for each income method, what it discusses is, what it is essentially, of course, that breakdown of how would you decide to choose one income method over the other. And slight problem, not that I have with your question, Mark, but the SIGA math. And when I use the SIGA model, it's not really a math application. When I'm evaluating positions, I'm not so much applying math into it as opposed to the what are my expectations, what are my personal goals. In my personal goals, I have a math range, a percentage range that I'm looking to accomplish on a monthly basis or perhaps over a certain set of time frame. But let's take the talisman energy position. And of course, Mark, you realize why I'm using this one is right now this is the one that's still up 5.2% already from where we entered the position on the February 8th webinar. We bought the stock at $23.27 and purchased the put option for $2.95. It was the July 25 strike put. Right now the stock's trading at $24.49 and the put price was $2.10. Okay, so we've lost 85 cents of the stock, gained $1.22 on the put option. Now, I know I'm going to have some income methods. With the stock up 5%, I could potentially do income method number 1. I might consider income method number 3. I will give you a little bit of secret on the math for income method number 3, or how I look at income method number 3 from time to time. Income method number 4, or perhaps income method number 6. All right, so what am I going to do now? We're going to look at position actions, and let's go to position analysis. Let's see what my rollout opportunities are for the talisman energy position. Well, the first selection, or the first section here, it's just the basic breakdown of our position. Bought stock at $23.27, bought the put for $2.95. Stock's currently at $24.49. Static break-even, or what I should say the expiration break-even, is $26.22. Stock plus the initial purchase price. If I hold it all the way to July expiration and make no adjustments on the position. Okay? I still have 143 days to expiration. My max risk was 4.7%. Now, the first thing I always evaluate, whether the stock has moved up, Mark, or whether the stock has moved down, I have to take a look right away at this first part. Before even looking at the rollout opportunities, I need to know this. Where do I stand right now? If I shut down everything, if I sold to close my put option and sold to close the stock, what is my current liquidation value? Right now we see we're at 1.4% for 15 days. By the way, many of you heard me in the other parts of the presentation, my sort of personal goals in trading in RPM is I do look to try to achieve maybe 2 to 2.5% per month in a bullish market. Expect to generate maybe 1.5 to 2% in a stagnant or neutral market, and maybe about 1.5 to 1% in a bearish market. Things change. I know it's not always going to be the same market. The great thing about it is that if the stock really takes off when I start off, we're not limited on how much we could make. We still have the unlimited upside. But with the income methods applied, or when I'm evaluating if I'm going to liquidate it, I have to see if this matches my goals. This might match my goals for the stock as far as that monetary return. 1.4% after 15 days translates to 2.8% over 30 days essentially. Just looking at the basic math, not the logarithmic increase. So right now this is kind of close. This is really matching my goals in the 15-day period. But I now have to evaluate the various income methods. I also want to keep in mind my risk. Okay, my risk when I originally opened this RPM was 4.7%. I'm not going to say you should trade in the same fashion, but these are the two things that I look at. And the reason why I start with those two is if I'm applying certain, well, let me show the income methods before I describe that. Okay, so let's take a look at some of the positions. Income method number 1, opportunities. We see some options here for April, which is 52 days out, and March. When we talk about the SIGA model, what are the current conditions? Even in sort of a bearish market right now, Talisman Energy is still up 5.2% from where we purchased it. We're looking to generate some income to lower our risk. Okay? Now, what are my expectations? Well, that's something I have to evaluate for myself. Looking at the stock chart, my sentiment of where the market is going, do I think this is continuing, do I think the stock's going to continue up another 4 or 5% in the next 15 to 30 to 45 days? Do I think it's going to pull back if things settle down geopolitically in the Middle East, for example? Will that cause oil to come back down and Talisman Energy might fall as well? These are some of the things I have to evaluate for myself based on what are my expectations going forward. And also my goals. Okay, well, just the static return here, first thing, when looking at income method number 1, and again, this is personal evaluation, I go to the near term first. You're always going to have a higher annualized return selling premium if you go month by month instead of going further out in time. These April calls that are listed are not bad choices, don't get me wrong. But normally if I'm selling calls or by themselves I'm doing a standard collar or maybe even selling a naked put, I try to keep that under 45 days out in time. 52 days out for me might be a little bit far. That's personal. Doesn't mean that's how you're going to trade, and that doesn't mean it's what you look for, but that's personal to me. So I focus on the short term first. Is this premium enough for me? 20 cents for the March 26 call? Probably not. Just straight numerics, without even looking at the profit and loss chart for this, I'm going to reduce my risk from 4.7 down to 3.9%. That's about a 0.8% decline. I don't know if that's enough for me. It is. I realize, without even looking at the chart, of course, that the 26, that's giving me more room for the stock to grow. It's another $1 up in strike price for the stock to grow. But I don't think that 20 cents justifies it. Honestly, if this was 50 or 60 cents, I might consider this. But for this to be 50 or 60 cents, the March 25 call would probably have to be 90 cents or 80 cents, and that would still maybe look more appealing. Well, okay, 50-cent premium on the March 25 call. We would reduce my risk to 2.8%. Right on the fence with this one. The reason why is when I look to do the first income method, yes, I want to lower my risk. Yes, I want to generate premium. But I also really would like to, and this is personal again, I would also really like to cut my risk in half. Kind of not doing it right here. My original risk, remember, was 4.7%. I'd want this to cut my risk down about 2.4, 2.3% if possible. All right, but okay, let's take a look here. We have my conditions. We talked about that. My goals, we just sort of reviewed that, remember, too. Now this does what? 4.7% was our original at risk. This is cutting my risk down by about 1.9% from 4.7 to 2.8. Remember what I said, in sort of a bullish market, I have my personal goals written out. If the market turns bearish, I have to take that in stride. So to me, I look at this as I'm generating 1.9% of premium. Okay? Does that match my expectation? Well, considering the market is neutral, it's a little bearish right now, maybe it does. Another aspect, let's say that the stock trades right at 25.10, right at 25.01. What would that mean? Let's go to that simulate trade on the March 25 call to evaluate that, okay? So here's our position. All right, now it's a little cluttered here due to the fact that we're using some single strikes, but we see the bump that we get from income method number 1, but then we still have this down draft here as the stock continues to move up to $30 or to $32 per share. Let's clear this up. Let me remove the 2. This is the standard married put that we opened. This was the original married put profit and loss chart. And the black line, this is showing us what our married put would be on March expiration. Why March expiration? Well, that's the position that we selected. The expiration, I'm sorry, the income method we're choosing. All right. Select the blue line there. What are we looking at? Okay, so the maximum profit. Let's say the stock was trading right at 25.10, 25.20 at expiration. Remember, we're only collecting 50 cents. So I have two choices there. I can either let it get assigned, liquidate the put, and expect a maximum return of around 4.2%, or I can put 20 cents or 10 cents back into the position to roll it to a higher strike. This is where sort of the, I don't want to say the art of looking at the stock, but this is where the expectation part comes in, and this is really more of a decision-making process in yourself. Where do you think the stock's going to be in the next 24 days? This drives, I know my explanation isn't the best, but this drives a lot of customers at times that I talk to on a regular basis during the coaching sessions crazy. And they'll say, why don't you sell the call now? The stock moved up 5% as you want. You can generate 50 cents, cut your risk down to 2.9%, still make 4.2% in the next 24 or for a total of 38 days, which matched your expectations. Why wouldn't you do this? Because if I'm expecting the stock to go further up, if I'm expecting the stock to continue to move and be trading around $25 or $26 if the market corrects, whatever my expectation is going forward, I don't want to do this. I'm not going to sell premium for the sake of selling premium. If you're in the stock market, what you'd have to ask yourself when looking at this position, does the premium that you generate match your personal goals for the position? Whether it's 1% per month, 2% per month, or so forth. Does it match the goals you wrote out when you got into the position? Does this blue profit and loss chart, the blue profit and loss chart for this new position with income method number 1, does this match your expectation of the stock going forward? Do you think the stock's going to be trading maybe just around $25 or a little bit below $25 in the next 24 days to March expiration? If so, this might work out for you. If not, if you expect it, that you are expecting it to go higher, to be trading at $25 or $26 per share, you probably wouldn't want to do this. And I know the argument, and I agree with the argument. Well, I got to start paying for this 4.7% at risk at some point. If I sit here and wait, what if the stock pulls back? Then I've lost the opportunity to do the income method. Well, maybe you've lost the opportunity to do this particular income method, but you might still be able to do an income method number 6, or maybe the income method number 8, on this position. This is how I evaluate the SIGA model myself. This is what I look at on the position. Current conditions I know. What has happened to my position since I opened it? It's stagnating, as Hal brought up at the beginning of the webinar. It's moved up 5%, as we're seeing with Talisman Energy here, or it's dropped 4 or 5% looking at a different stock, and I might want to consider income method number 9 or income method number 9 combined with income method number 1. But does it match what I'm expecting to happen next? When I do income method number 9, for example, and I adjust the put, I do that only if I'm expecting the stock to recover. If I'm uncertain about the stock now and I don't think it's going to move back up in price, I wouldn't do income method number 9. I'd probably liquidate the position, to be honest with you. Take my lumps, liquidate for maybe that, well, in this case, just the 1.4% return, and then look for another position. That was a bad description. If my stock had fallen 5%, I wouldn't be at a 1.4% return. I'm sorry. If the stock had dropped 5% with its 4.7% at risk, I might only be down at about a 3.6, 3.7%. Might take that and then move into a new position. Okay, let me close that for now. Let me look at some of the other opportunities quickly. Here's a choice. Here's what I was referring to. It's a little bit closer, talking about 2.8% for that income method number 1 to 2.6%. with an income method number 4. Selling to close my current July 25 put for 210, buying to open my 27 put now for 360. I'm adding $1.70 into the position for a payout of 2 points higher. Well, that's really only generating about 30 cents extra, isn't it? Oh, no, I didn't do the math right. I apologize, ladies and gentlemen. It's an increase of $1.50. Selling to close my put for 210, buying the new put for 360. So I'm putting in $2.50 of debit, $1.50 of debit for a $2 higher payout. So that's almost the same, generating 50 cents, getting a higher payout on the position of 50 cents higher to reduce my risk down to 2.6%. Now, what's the risk of doing an income method number 4 in this scenario composed to income method number 1? Well, again, the conditions, the stock's moved up 5%. I'm looking potentially to apply an income method. We saw what would happen with income method number 1. Here's what would happen with income method number 4. I didn't generate any premium. I did guarantee myself a higher payout at 27 by adding $1.50 essentially into the position. Selling for 210, buying the new put for 360, and then gaining 2 points of a higher payout. So my risk now is $72 or 2.6%, and I still have the unlimited upside. The stock's right now at $24.49. What is the risk of rolling from the 25 put now to the 27? Well, my risk is if I applied this income method number 4, my expectation would be that going forward over the next 30 to 45 days from today, if I did this, I'm expecting the stock to be trading at 27. When the stock moves up to 26.50 or 26.75, that's when I'm going to do another income method. However, again, if our conditions are the stock's trading at 25 or 24.49, and I expect in the next 24 days the stock might be trading right around $25 per share, a little bit above or a little bit below, hey, that might be a good choice for one of those income method number 1s. If I'm expecting the stock to move further up in price over the next 30 to 60 days, I can reduce my risk almost in half to 2.6%, and then I can look to make another adjustment if the stock's at 27. Okay? I think I've talked to you about this before, Mark. I've made the mistake on my craft position of rolling too soon. When I had craft last year, I moved from the 30 to the 35 put when craft was trading at $30 per share, almost bulletproofed the position. But then I had to wait really about 3 or 4 months before applying another income method because the stock didn't get back to where I needed. It didn't move back up to 35. The highest it got at one point I think was 33.40 or so, 33.50, somewhere along those lines. This is how I use the SIGA model, Mark. It may not be how everyone wants to use it. It may not be how everyone chooses to use it. But when I think of the SIGA model, that's my approach. I want to take a look at this. I have in my mind what my goals are, the G for the SIGA model. What are my goals for the position? If I do an income method, I want to cut the risk down by half or at least cut the risk down to a point where it's that 1.5 to 2.5%. I look for a neutral to bullish market. Now, to tell you the truth, if I was in this scenario right now, looking at these different income methods, I may choose to go out to April, but I doubt it. If my expectations right now, the stock was going to continue to move up, I'd be patient. I don't think I would apply any of these income methods right now, and I know everyone doesn't want to hear it. What's the point? Why not do an income method? You have to start reducing your risk at some point. Well, if my expectations are that the stock's going to continue to move up in the next 15 to 30 days, I'll have a better opportunity to use still income method number 1s or income method number 4s or income method number 3s, but I'll have different opportunities to do that. And if I'm right, it'll work out. If I'm wrong, and I see the stock start to pull back over the next couple of days, maybe I'll have to do something different. Maybe I will try to look for something at that point, but it won't be as good as it is right now. I understand that, and that's kind of the problem. All right, Ivan. In Blueprint, it's stated to use income method number 1 once stock has moved up to the put strike price or higher. Yes, those are standard rules. But on the HPQ example, on November 27th, showed that Kurt put income method number 1 when stock was lower than the put strike price. Under what condition can you apply income method number 1 when the stock is below the protective put strike price? Okay, Ivan, I think the first concept there on the HPQ, is that what you said? I apologize. HPQ position, it's irrelevant, but really that was Ernie's position. Okay, so that was Ernie's example in HPQ. Now again, when would I look to do an income method number 1 if the stock has not traded at my put strike price yet? Well, this example, the stock's not quite at our put strike price. It's close. It's at $24.49. I guess we'd kind of call that at. But again, I'm going to see these opportunities to apply the different income methods, and I'm going to walk through the same processes. Does this March 25 call, does that chart with income method number 1 included match my SIGA model? Does this match my SIGA model? Okay, let's take an example of kind of what Hal was discussing before, all right? let's take that CarMax position. Howard talked about, hey, he was concerned. What does he do if he's in a stagnating stock? And Hal did write back, I think. I scrolled down a little bit ahead of time. Hal wrote back in and said that he couldn't do the Iron Condor one because he isn't too restricted of a retirement account. And that's okay. You could still do income method number 6. To tell you the truth, Hal, most of my RPMs are in a restricted retirement account as well at Fidelity. This is where that account is. It's kind of, I can't change it out of there for specific reasons I won't go into. I probably would if I could to have more income methods, but I do have a cash account at Options Express where I can do those. But for Ivan's questions, let's take a look at the CarMax position. The stock at one point moved up, we know, to at least 35.60. It wasn't quite at 37, but it was closer. Right now it's back to 34.59. Is this an example where you might consider doing income method number 1? Well, it won't show up in the position analysis because it hasn't matched the expectations of the stock moving up at least 5% to trigger the bullish income methods. But let's again go to the profit and loss chart, which will take us to that custom spread tool menu, and evaluate what we can do. Okay? Now the rules, let me step back and take another approach to this. The rules in the blueprint are written based on Kurt's experiences and customers' experiences since he first penned it about 9-10 years ago. The recent additions also include Ernie's thoughts, my thoughts, and other customers' thoughts on what works and what doesn't. The guidelines that are set and that we advocate for doing income method number 1, income method number 4, income method number 6, and so forth are based on our experience of trying to play around with it, mostly Kurt's, of course, don't get me wrong, and having positions go wrong because we entered it incorrectly. Now, that Ernie's trade on HPQ where he sold the income method number 1 below the put strike price, or not even below the put strike price, but he sold it early. What you'd want to do, Ivan, is you have to evaluate. You can do it. Let me step back. We put the rules together to keep people out of trouble. Why do you never do income method number 1 when you open an RPM? Because it caps your gains and it can increase your risk on the upside if the stock spikes by a large percentage. Does that mean you can't do it? No. You can do whatever you want to. I can't stop you from trading. If you're at your computer and you're placing an income method number 1 trade where the strike price of the call is below the put or isn't at least a third of the maximum risk as discussed in the blueprint, or you're doing it before the stock's up at 5%, I'm not going to show up at your door and grab your hand so you can't place the trade. You can do it, but the reason we advocate it is because, remember, it's capping your gain and it might add risk to the upside. So for this example on CarMax, let's just look at the March calls. They have relative premium. The 37 again is at 20 cents. The 36 is at 45 cents. We looked at that one, but let's go ahead. I hate to do this, but let's go ahead and add the 35 call. You know what? No. Let me do the 36 call, but let's do it for April. Going against my rules, let's go out 52 days now, and let's do the 36. Decent premium, $1.20. Not too bad. I believe our maximum risk on this is only $1.89. Is that right? Yeah, $1.89. So let's go ahead and sell that 36 call. It's below the put strike price. The stock hasn't reached the put strike price, but we are collecting a decent amount of premium. So let's go ahead and graph this and take a look at it. Okay? So here's a setup with income method number. Did I do that wrong? Oh. Okay, let me try that again. I added both calls in there. Let me sell the April 36 call for the $1.20 now. Much better. It's actually grabbed $1.30. That's okay. My risk range is still tolerable, 4.2%. Okay. My maximum return, if the stock's trading right at 36 at April expiration, is about 3.7%. 52 days plus the 14 days, that's 66 days, 3.7%. Yeah, it's close to my it's close to my personal goal. I'd be looking for more than I'd be looking at about 2.5% if I'm still bullish on the position. Not fully there, but close. Okay, it's close. Here's the rub. Stock's at 34.59. For the next 52 days, if the stock continues to move up as I'm expecting in a regular clip, I'm going to be watching it and watching it. Okay, it goes above 36, let's say around March 15th. Now I've got to consider buying the call back for maybe a higher premium than I collected, then rolling maybe to the 37 or the 38 call, excuse me. These are things you can do. It's just if the stock continues to move up, if the stock recovers and moves up as I'm expecting and goes back to 36 or 37, I might be better off waiting, not selling anything right now, and applying a better income method going forward. It's personal preference. There's nothing to say you can't do it, Ivan. Just make sure you look at it and evaluate, hey, does this match what I want to do? Does this match my position? Let's say, for example, that we wanted to, and you know why I'm saying this. Let's say that we took the other road and said, you know what, this position's doing nothing for me. I'm going to sell the 35 March call right now for 80 cents just to try to get out of the position because I'm not happy with what it's doing over the last 14 days. So I rush in, and we now sell the 35 call too soon, 80 cents, well below the put strike price. What happens? Well, 2.1% gain. We've got an upper and lower break even. Hey, if your expectation is that you think the stock's going to be trading right around 35 in the next 24 days, you're happy with the income you're generating, you're not concerned with this maximum risk at 8.1%, maybe you could do it. And you could do it. I'm sorry, not maybe you could do it. You could do it. I'm not going to really, I mean, if you call me and you say, hey, Mike, I went into this too soon and I sold the 35 call below the put strike price, now the stock's trading at 36 or 37, how can I adjust it? Well, I'll show you how to use the PowerOptions tools to do it, but you know what my answer is going to be. Well, you probably wanted to wait for the stock to move first before you did this particular one. Always graph it just to see. There's no law. It's not written in stone that says you can't do it. It's just you're taking on extra risk on the upside if you do it too soon and you sell the call below the put strike price. Make sure it matches your SIGA model. Make sure it matches your expectations and your goals. That's the best way I can answer that question. Okay, hold on one second, okay? Oh, sorry, just going through some of those. Okay, is this Rich? Rick, I'm sorry, Rick, not Rich, I apologize. I saw your email 2 minutes before we started the webinar, so naturally I couldn't get to it. And I think you sent it to me, and I thank you for sending it to me early so that I could have it prepared to go into the presentation. I discuss it during the presentation, but I'm sorry I didn't get a chance to look at it beforehand. Rick wanted to know, he's been looking primarily at big charts, analyst recommendations, option chains in recent weeks. He's found stocks that meet all his other criteria, high open interest, other charting things he's looking for, earnings report date, and so forth. The option premiums are very skinny, thus you've sat on the sidelines for a while. Are low option premiums a significant part of your criteria? No. And I'm not going to let that be the end of the answer, Rick, but I am going to answer no, they are not. In part one of our discussion using the search tool, I did discuss that when I first started trading radioactively, when I first ran an RPM, let's just go to that model right now. We had those two positions that popped up, Penn West and Ascena. Let's look at Penn West first. When I have the positions that pop up, when I first started trading radioactively, I would, go to the option chain. So here, let's just take a look. Stocks at 28.20, showing the September 30 put at 390, and the total at risk is 210. So over the next 206 days, we want to try to pay off 210, really more than that, but just basic view. So when I first started, the first thing I would do is say, okay, let me go to the option chain, and just for the next month out, with the stock at 28, what is the at-the-money premium? Well, this pulled up the 5-strike put chain, but I'll just change that to the 5-strike call chain. Let me open this up to a fuller view, guys. There we go. How about that? All right, and the 29 strike, 24 days out, is 40 cents. So assuming that everything stayed the same and I can always generate 40 cents, essentially what does that mean? Well, with 210 days to expiration, we almost have 5 cycles, almost. It's really about 4.7 cycles where we could sell this call. So if we sold this 4 times, that would give us $1.60, for example. If we sold it 5 times, it would give us $2. Just about pays for the premium. And then I started to realize, and this is probably more historical and more in-depth than anyone wants to go into, but based on the positions that I was trading, I found it better to, when I do my first income method, I try to focus on income method number 4 or perhaps income method number 6 first, because I don't want to limit my upside. For that reason, I don't look at this anymore. I try to consider income method number 1 as my last resort. unless it almost bulletproofs the position like it did in that historical silver Wheaton trade, which is in the archives that you can take a look at, where I did essentially bulletproof the position after the first 30 days with an income method number 1. But Rick, I normally don't look at the call premium anymore. That's the process I would go through if I wanted to use that. A couple of things right now that are probably hindering what you said option premiums are skinny. Number one, if I'm using search criteria that are looking for strong, stable stocks that have high open interest, relatively low risk, good stock strength, fundamentals, and technicals, well, the rest of the market sees that as well. Most of the stocks you're pulling up in your search are probably not stocks that tend to fluctuate on a large scale. They tend not to have a lot of fluctuation. Ergo, the volatility and the implied volatility is going to be relatively low, and there's not going to be a lot of option premium. It's a trade-off. If I'm looking for really strong, stable stocks, and stocks that pay maybe a high dividend, for example, these are stocks that aren't going to have a lot of rich premium. I can't have both. If there are stocks out there that match that criteria and have a strong premium, naturally, of course, you'll be able to identify them using these tools. But it's kind of tough to do that with the types of stocks you might be looking for. The market as a whole knows these are also good, strong growth stocks, and there's not going to be a lot of premium because the implied volatility, what's commonly referred to as the risk, is not really inflated on those positions. You might try to loosen up some of the criteria a little bit. I don't always like to suggest that because what you're doing for your stock selection has been working for you, and that's why you're using it. But we can't have a trade-off. During one of the last presentations, I discussed that when I'm trading radioactively in my personal portfolios, some of my positions are on dividend-paying stocks that I'm never expecting to use income method number 1 on because there's no premium. And some of my other stocks are more volatile and lower priced because they do have enriched premiums, and I might consider a 1 or a 6 against them. It's almost like diversifying my RPM positions based on if I'm looking for growth or if I'm looking for income. Okay, sorry. Let me move on to the next question. Chuck wanted to know if the goal is to hedge a stock you're holding with a goal for dividend income. Okay, so I want a long-term position with dividend income and dividend growth with a long-term stock. Do you basically use in-the-money leaps and look to other income methods to eliminate risk? How do you approach a long-term hedge strategy? Okay, this went in perfectly to what I was just saying. Typically, do I have one here? Let me pull up this dividend search from January 25th. This is a search in a past webinar I created looking for stocks that matched my criteria but paid at least a 3% annual dividend. A lot of the positions, Chuck, I've traded with this approach are listed here. I'm sorry about that. Some of them are listed here, I should say. I always look to see if they stand out. Craft, I trade this on a regular basis with the RPM technique. Yes, I'm still in the money. I'm still following the rules. Here's a September 33 put with Craft at 31.68 and a risk of 4.2%. I probably wouldn't do this one because I would look for the January leaps. That's my personal approach again. Did I trade any of these other ones? No, I didn't. Oh, no, Altria I did as well in the past. Heinz I looked at, but that stock moved so slowly for me during the time. And of course, as I say that, it's up $1.23 today. So I didn't trade Heinz, but it's come up a few times. Other ones, of course, were at the time Johnson & Johnson and a couple other, Bristol Myers. Okay, so I still use the same approach, but yes, I'll typically look to the January 2012 or maybe even the January 2013, depending on the time frame. You can still use income method number 1. The premiums are lower, but remember the reason why it's lower is because of the factor of the dividend. You know, this particular stock, Kraft, for example, pays about a 4.4% annual dividend, I believe. So, yes, I'm not getting the same premium I would over time using income method number 1, but I still am augmenting that with a dividend payment. Now, what I found, though, is that it's income method number 6 is really hard because a lot of times when I was trading Kraft and I looked for an income method number 6, the profit and loss chart came close to matching my expectations and my goals, but the net premium I was receiving was only 10 or 20 cents with a 2 or 3 point strike difference. Only holding 400 or 500 shares. It's just didn't really match what I was trying to do there. It's a little bit more difficult, Chuck, to be honest with you. Using that approach with the dividend stocks can be lucrative. What I managed to do with Kraft now is essentially I have the position bulletproof each time I roll the put. When I hit January 2011 expiration, I did roll the put to January 2012. Actually, I did it in December after I did other income methods. At that point, I was guaranteed a return of about 11%, some of that from the dividends, some of that from the income methods. And when I rolled to January 2012, the position didn't cost me that much money, so I'm already bulletproof with a guaranteed return of about 9% for the next year. I know at least I'm going to collect that 4.4% dividend, so I'll have 13% on the position. 4.4% over the year isn't that much, but I would still expect the stock to grow over time. It is a lot slower than other RPMs. I mean, it is, sometimes you'll find yourself watching it for 2 months to 3 months before looking to apply an income method. Oh, wow, missed some other questions. I'm sorry. Let me scroll back up to the top. Oh, okay. Joel wanted to know, wondering if all the other Power Options Q&A sessions are saved online. I missed all of them except this one. Okay, this is the only Q&A session for this series, Joel, for the Power Options for Radioactive Trading. I'm not wrapping up here. Let me just go into the Learning Center. So go to Home, go to Learning Center, and then I'll click on Webinars from our Learning Center menu. Every Friday at 4:30 p.m. Eastern Time, I host an open discussion presentation. This one is particular to the radioactive trading techniques and using Power Options for radioactive trading. But on the archive page, we have the Tools Archive, Strategies Archive, and Open Discussions. If I click the shutter, I should put more descriptions in here. We just have some basic open discussion presentations recorded. These are done every Friday at 4:30. Now, this particular education series, the Power Options for Radioactive Trades Archive, Part 1 was the search tool, and I did most of the material there. Part 2 was an open discussion mainly on the search tool, but we addressed some other issues here. So that was another open discussion that was available. Part 3 was the research and analysis. This might, Rick, you might, if you haven't, I thought you had, but Rick, if you hadn't gone through this, you might want to check out the research and analysis one. I don't know if that answers your question a little bit more than we just discussed, but you might want to review that archive. And then the portfolio tools. And of course, this presentation will be archived here as well tomorrow at some point, the open discussion for tonight. But open discussions for Power Options Tools, Radioactive Trading are usually every Friday at 4:30. This one's specific to this educational series that we're wrapping up, and you can view the other presentations in that series in the Power Options for Radioactive Trades archive there, Joel. All right. Okay, let me go back to the portfolio. Mark asked, is there anywhere that shows the per share price plus the put for total cost per share? Well, yeah, the profit and loss chart show that, Mark. If I read your question correct. Oh, nope, sorry, my portfolio. Let me go profit and loss portfolio. Okay, so basic view of the portfolio. You have your issue price per share, and of course the put contract price per contract. Then monetarily, of course, it was $4.50 and $34.39. All right. Now I haven't made any adjustments. My effective cost per share is still $34.39. As I scroll over, when I've added the View Position Analysis checkbox onto my portfolio. Now this one's easy, Mark. I apologize. Of course, you see where I'm going. My total position cost is $38.89. Well, that's my price per share of the stock plus my price per share of the put, divided by 100, for example. That's with doing 100 shares. Okay. Now, if I'm not mistaken, if I go to the position analysis screen, I thought that showed it. Lack of a better term, it does show it, not in the sense that you're thinking of, Mark, but it is shown here. The price per share of stock plus put, that's always your break even, $38.89. And as you make adjustments, of course, in the profit and loss chart, in the position analysis screen, the effective cost per share will keep lowering. So wherever your break even is, that's your net debit. That's your total cost per share of stock plus put. I think that answers your question. I hope that answers your question. Let me know if I misread your question, Mark. Okay. Okay, Ivan wants to know, what is the fair recommended stock option commission rate? What is the rate from Options Express? They have a special rate for PowerOptions customers. Okay, we do have the broker link here. When you're in the search menu or from your portfolio, where you can link to Options Express through the broker link to close a leg, or if I'm in the search tool, I'll have to buy the stock, to buy the put, for example, or enter it as a married put. We did have a special pricing with them a couple of years ago, a discounted rate for PowerOptions customers who were using the broker link, but then they changed their pricing structure and actually they just gave it to everyone. So automatically everyone was receiving their best pricing rate. Options Express is fair pricing. Do not get me wrong. I think their options prices are fair, but there are lower prices. Thinkorswim offers lower prices. Trade King, I believe, has lower prices per contract, but I think Trade King goes up faster by the number of shares and number of contracts than Options Express does. Thinkorswim, forgetting the other interactive brokers, wow, they have some really low price commissions as well. I think Options Express is fair. I think they're a fair price, very fair price. But I know that there are some lower ones out there. But what you have to figure out, Ivan, is you have to do some of that research on your own, because you have to figure out yourself is, okay, with all these ones out there, you know, not only in addition to what is the price per contract and the price per share, you have to talk to them and figure out, okay, well, how quickly does that go up if I do 500 shares and 5 put contracts? How much does it increase if I did 10 and 10, or if I did 2,000 shares and 20 contracts? Is that more of a fair comparison? You want to take a look at that. The rate that Options Express has right now is better than the rate they originally gave us for that discount, and everyone gets that right off the rate, Ivan. So you want to just do some research there. Some of the names you're going to want to look at: Thinkorswim, Trade Monster, Trade King, Interactive Brokers, and Options House, I believe, is optionshouse.com. I believe they have fair competitive prices as well. Oh, yeah, Mark came in. Be careful of hidden fees, Ivan. That's very important. You know, hidden fees, if there's a excuse me, if an assignment or expiration, if they have different prices there, that would come into play. Mark wanted a different Mark. I have a Mark L here. Mark T was asking us the questions before. Mark L wants to know, Mike, when would you use income method number 5? When would you not? Kurt actually had a great back and forth with Mark T earlier today regarding income method number 5 and even using the PowerOptions tools to implement that. Mark got a better response from Kurt than he's ever gotten from me as far as income method number 5 goes. And I mentioned that Mark L because I believe Kurt's going to turn some of that into a blog description about using income method number 5. When do I use income method number 5? Let's use the Talisman Energy example. I'm going to go to the custom spread tool to evaluate an income method number 5. And I'm going to use it, and I'm not going to dodge the question here, but the basic response is I use it when it matches my SIGA model. Now let me explain what that means. I'm still expecting the stock to move up, Mark. When using income method number 5, I'm still going to want the stock to be trading maybe up 4, 5, 6% from when I purchased it. Now, let's say here in this example, Talisman's up to 24.49, close to 25. We have the 25 put. I'm going to run a basic setup without even looking at the prices of buying 1 March 25 call and selling to maybe 27 calls, I guess. Let's see what that looks like first. All right, so I'm going to go here, go to March. I'm going to buy 1. Wow. No, I'm not going to do that. We're going to have to use the 26 call. Okay, so I'm going to buy 1 March 25 call at about 65 cents. And we're going to assume that I can get the bid-ask spread here of about 20 to 35 cents with the 26 call. Okay, so buy 1, sell 2. And this runs into the situation that Mark T is recognizing that it's difficult to sort of analyze this on the custom spread field, but I find very few opportunities often enough where I can do this at a credit. Usually I see the income method number 5s at a debit and they don't match my SIGA model. But we'll see if this one does. Let's be fair. Let's adjust the prices a little bit. Let's say it only costed us 60 cents to get into the March 25 call. And let's say I could sell this one for, let's call it 25 cents. So only a 10-cent debit on the position. All right, let's go ahead and run that. See what we get here. Okay, so it's pretty good. You know, this isn't too bad. If my expectation was the stock was going to move up a little bit more, move up to 26, could have a potential return of about 7.9%, but I did increase the risk on the downside. That's assuming worst case scenario, right? The what if scenario. What happened if the stock went bankrupt, went to 0? Well, my risk would be up to 5.1% from 4.9. That's because I added the debit of 10 cents. And if the stock went to 0, I've now upped my cost basis to 26.32 from 26.22. That's why my risk is now 5.1%. Okay. Best case scenario, stock's trading right at 26. The 226 calls expire worthless, and I sell to close my 25 call that I bought for 1 point. Okay. So the SIGA model is, okay, maybe the stock hasn't been doing too much recently, but I'm expecting a move over the next 24 days. Maybe I want to generate some income. Now, you also don't see a lot of premiums with the stocks I'm trading for income method number 5 because I'm using the lower price stocks. Normally, when I see Kurt do an income method number 5 position, it's maybe on a maybe on a $50, $60, or $70 stock, which has better premiums, or an event's coming up where he can take advantage of the income method number 5 maneuver. I think usually with income method number 5, you might want a catalyst coming up, maybe earnings or maybe some other event, or your expectation is the stock's going to pop and you're going to be able to take advantage of the difference of the bull call debit spread plus some of the premium you collected from the other short call. Man, I don't usually apply this technique. What I'll try to do, Mark L, is I might forward you Kurt's thoughts that he sent to Mark T in the email today. Not the specifics of the trade, just Kurt's thoughts, copy and paste them out of his income method number 5 thoughts. But I do think Kurt's going to write a blog on that, and I'll make sure you see that. When would I not do an income method number 5? Honestly, if my expectation is the stock's going to continue to move up. Really, if I expect the stock to be trading in this case, maybe 27 or 28 in March expiration, I'm probably not going to do this income method. What I'd probably do, if that is my expectation, I'm going to wait for the stock to move up closer to 25, maybe do an income method number 4, because then I'd cut my risk down and then I'm still expecting it to move up to maybe 27 or 28. Personal approach. Kurt would probably disagree with me. He might say, hey, this is a great time to do income method number 5 or do income method number 6. That's the great thing about this technique. You can apply it different ways based on your tolerance and what you're looking to achieve. So Kurt might jump into this right away and say, hey, that's a great time for income method number 5. Oh, Richard, the only brokers that are available right now through the broker link are Options Express and Brokers Express. I can't show it because this is the webinar account and it's not linked to a real trading account. The only time you would see that is if I had it set up to link directly to a real Options Express or Brokers Express account. Okay, those are the only two that we have linked right now. We had another question coming from Rick. This is Richard's question about those. Those are the only two we show. And Rick wanted to know, do you have any plans of looking at TOS or linking to TOS? We did. We were in talks with them. And then when they got bought out by Ameritrade, Ameritrade said we want no other third parties ever linking to TOS. So the door was closed. We'll never be able to do that. Apologize for that. I wish we did. We were in talks with them. We were trying to get it going. And then when Ameritrade bought them out, the Ameritrade, we were told, did not want any third-party data software linking to them. Okay. Roger asked a question. Since you have been trading this method for several years, well, I've been trading it for 3 years, not several. Kurt has been trading this for 9 years. What is a rough estimate that you can generate per year basis? I've been really average, not average return, but I'm still really able to manage my goals with this position. What I mean by that, When I first started working with PowerOptions 8 years ago, Roger, I learned covered calls because that was Ernie's bread and butter. I also learned naked puts. And I saw the disasters that many investors started to face by looking for those covered calls that had that 5% return, 6% return because something big was coming up on the horizon, for example. And I knew to avoid those. I knew that the best way to trade covered calls was to look for good stocks and expect only about a 2 to maybe 2.5%, 3% return per month. That was the best expectation. That's still great. That's still 36% per year. And on the positions that I was right on, hey, I was making that. But what about the ones that gapped away from me? Well, I've got several positions making 2.5%, 3% here if I get assigned, and I've got 2 positions that have dropped 15% in a gap, so I'm really on those down total of 30% in my account, and I'm up 24% from the other 8 positions that I made 3% on. Eep. That's a problem, all right? With this technique, am I cutting into some of my expected returns? Yes and no, in my opinion. Let's be honest. Let's take a look here. Bought Talisman Energy on February 8th, 23.27. The stock's up $1.22 or 5% from where I purchased it. But I also paid for a put, which is down 85 cents. So my liquidation value that we saw is only 1.4%. Did I cut into some of my gains to have the insurance? Absolutely. I can't deny that. That's obvious. But I did it because I didn't know if the stock was maybe going to, if I opened the stock and I was wrong, if it dropped 10, 12, or 15% over this 14-day period, especially if it gapped. If I'm using a stop loss and it gapped, I'm now in trouble, right? If I had just bought the stock, I'm on the hook for that 14 or 15% loss. Now, the stock doesn't have an expiration. Sure, I can try to manage that, but it's a pretty big loss to take. Okay, so I'm doing that in my personal account. All the stories I've heard, I talk to probably 20 to 30 customers over email per day and about 15 to 20 customers on the phone per day. Some days it's more on the phone. It's maybe 30 to 40 customers on the phone. Sometimes, you know, it's only 10 or 15 customers via email. It varies, but I've been doing that for 8 years. When I first started trading covered calls, and this is how I learned from Ernie, and I was looking to make that 2.5 to 3% of that 2 to 3%. We were linked, or we were partnered with other companies that were doing the seminars that were teaching, hey, you can make 3 to 4 to 5% per month using covered calls in your account. After about 5 months of doing covered calls, I quickly learned the values of standard collars, which I still trade to this day. It's not the married put technique, it's standard collars. I'm still using puts for protection, but I still have to be right more often than I'm wrong in order to make money with a standard collar. All right? But I'd always hear the funny thing from covered call customers that have been trading for 2 years or 2 months. I recently got burned on a covered call position. I know there's no way I can really manage it, but how can I avoid this going forward? Well, did you have a stop loss? Yeah, but the stock gapped. Well, stocks are going to gap. That's going to happen to you. Well, have you ever considered using a put option? No, it costs too much money. Okay, you could have bought a put option that would have limited your risk to only 4 or 5%. Instead, right now, you're holding a stock that's down 25% on a covered call position, and the put costs too much money. Now, everyone has their own personal tolerance. With this technique, I've still been able to match my goals of about 1.5 to 2.5% per month for the past 2.5 years. In the decline, and when we showed this in one of the CD presentations in the advanced income methods, we showed my Office Max trade. It was my first RPM. I opened it in April, 3 years ago, April of 2008. That was my first RPM on Office Max. By September, I believe the stock was down 75% where I purchased it, but I closed it for a gain. It was only a gain of about 4%. Didn't match my goals, but it was better than trying to adjust a stock that was down 75% from where I purchased it with covered calls. I had limited my risk. I'd rolled down the put with income method number 9. At one point, rolled it back up to bulletproof it, sold a couple calls, and it went down to 4%. Or it was closed for about, it was probably about a 3.4, 3.8% gain. I can't remember off the top of my head. So I'm still able, in my opinion, to match my goals. Average return, I'd say, I expect, using the radioactive trading techniques, to make about 12 to 15%. It was a much higher return if I looked at the 1-year time frame from, March 2009 to March 2010, and we hit the bottom and then everything went up. Yeah, I did better in that 12-month period. I'm not going to say I did better than a covered calls trader because everything was going up at that point. But I did much better than my expectations in that time period. stagnant time frame recently, the past couple of months. Let's throw out between, well, we'll include January, but I've still been able to do income methods and adjust my risk down by 1% to about 2.5% every 30-day period. That's lowering it and then increasing it, still giving me the return. I think the 12 to 15% is a reasonable expectation with this technique, personally. If you're in a bearish market, sure, you might have a losing year, but your portfolio is only going to be down 5, 6, or 7% if you follow the rules, while everyone else is looking at mutual funds down 40 to 30%, 30, 35, 40%. Which one would you rather have? I know it doesn't sound glamorous. This isn't, Kurt always says it, this approach is not as sexy as the promise of covered calls trading, selling premium, or, ooh, leverage credit spreads. Let me do a credit spread, only have a 5-point risk, and look to make a 20 to 25% return. Yeah, but when I'm holding a position and making 50 cents for a 5-point risk, if I ever take that maximum loss due to a sudden gap, which I can't control even with stop losses, I'm just wiped out 10 previous gains. I'm not going to guarantee you a return. This is what I've been able to make, and this is what I've been able to expect. Ernie, I think, does a little bit better than me. I know some of our radioactive traders do better than that. Some of you have heard Kurt talk to Bill, who joins us on our webinars. He's been using the technique for a couple years. Some of his returns, I've heard, have been fantastic. So I can't guarantee a return. I'm never going to do that. I can only guarantee that using this technique, you'll never give back to the market those ridiculous losses for sudden gaps or unexpected events. You're never risking more than 4 or 5% on any one position. You shouldn't be risking more than 1 or 1.5% of your total portfolio value on any one married put position. Okay, Ivan wants to know, if I'm tracking a position in the power option portfolio, I don't have a covered call here, but let's just say with the married put, let's say we were at expiration and CarMax was below 37. For exercise and assign, does this happen automatically or manually? You have to do it manually. Let's say I did have a covered call here recently, let's just say on CarMax, and I had the February 30 strike call that hit expiration last week. Well, we're not assuming that you just left the position open, and so we're automatically going to trigger an assignment for you. You might have bought it back. We don't know what you did, how you adjusted your account in your portfolio. So you'd want to go into the position actions menu. I'm sorry, let me select something else. When you go in the position actions menu, you're going to want to sign exercise or assign, for example. You're going to have to do that manually because we don't know if you bought to close it. And then in that case, I'm sorry, if you bought to close the position, you would just go close leg or close position, for example, or exercise assign, okay? Because we don't know what you did in your portfolio. We're not going to assume you let it get assigned because if you bought it back and rolled it, then Oh, Mark, I did one a while ago, actually. If Mark wanted to know, I apologize. Mark L., you're going to do a webinar on the history function of Power Options, on the Power Options historical tools. There is one already in the archives. Again, we just go to webinars. Go to the Power Options Tools archive, and number 3 is Power Options Historical Suite of Tools. If you already watched that one and you didn't like it or it didn't answer your questions, let me know what your questions are, and yeah, I might do another one in the near future also. All right. Shook asked a question, Mike, do you always do the Mary put right after you buy the stock? Yep, I do now. The RPM is based on doing them at the same time. When I run my search, and these aren't my personal searches, these are for the webinar account, for example, but in my personal Power Options account, I have various searches created. When I run the search, these numbers in this position I'm seeing is exactly what I want at this instant. I'm not going to try to play the position and say, you know what, I bet you I could buy Kraft right now at 31.68. Excuse me, ladies and gentlemen, I apologize. Frog in the throat there. Apologize. I bet you if I bought Kraft right now at 31.68, in the next 3 or 4 days, I think all this turmoil is going to settle down. I bet you it's going to be up near 32.50 or 33, and at that point I could buy the 33 put for a lower price. Yeah, that's great if I'm right, but if I'm wrong and the stock drops down to 30, I'm scrambling now to find a put that's not going to cost me too much money to be outside of my mounds. When I'm trading radioactively, these are entered all at once. Buy stock, buy put together. Know right away what my risk is, both my maximum monetary risk and my percentage risk. Mark T, do you ever just let the stock run, or do you always adjust as it goes up? A good description of that would be that archive presentation on the silver Wheaton position. Have I done that recently? Hindsight 2020, if I knew, but this is always the trick. This is why we trade radioactively, because we don't know the future. Let me answer this question honestly. No. Trading radioactively, Mark, in the last 3 years, I've never just held a position and let it run up. Once it moved up to a point where I could apply income method number 4 or an income method or bulletproof the position, I did that. I tried to generate some income or bulletproof the position so that going forward, if the stock reversed, well, I was bulletproof, okay? So I do make the adjustments. I've never just let one run, because if I knew the future and I knew the stock was going to run, you remember the silver Wheaton position. Stock went from $17.20 in May when I bought it up to about $40 per share. If I knew that was going to happen, if I knew that from May to December the stock would have moved from $17 to $40 per share, I got to be honest with you, I probably just would have bought shares of stock. You know, not added a put to it, not done anything else, but I didn't know the future. As the stock moved up and kept matching my expectations, I adjusted it to bulletproof it, guarantee a higher payout, and then look for further income. Had I known that the stock was going to do that, I might have done something different, Mark, but I don't know the future, which is why I do that. Oh, this is an interesting question. And Chuck came back and said, Mike, am I right to think that the radioactive method requires a fair amount of monitoring in order to do the adjustments? Nope. I don't think so. Let me explain why. Now, that's me personally, and I'll be honest with you. I've missed opportunities rolling the positions or applying income methods. Here's the deal, Chuck. My job is not as – I'm not a trader for life right now. I'm not trading for money. This is my job. I'm on the phone all day. I host webinars. I host coaching sessions. I'm not looking at the market. In reality, Chuck, I spend probably only 2 to 3 hours per week looking at my positions. Do I miss income methods because of it? Yeah. It's talisman energy position, not the talisman energy position, I apologize. That CarMax position, ooh, probably shouldn't have said that, but too late now. The CarMax position at one point was up. Let me just see where the stock chart went to. What was it, a week ago or two? No, not a week ago. Was it a few days ago, 6 days ago? Ah, here we go. Profit and loss chart. This was the CarMax position from the 8th that we've been looking at. Oh. Yeah, someone hit me later for clicking the wrong link there. There we go. This is what I wanted to see. Okay. Okay, yeah, it did peak out. It looks like, let me do the Java chart here so I can hover over that interactive chart. I apologize. Hold on one second, folks. There we go. Okay, it looks like the high was at about 37.02, 36.50. This was on 2/18. This was on Friday. This was on expiration day. I was handling a lot of phone calls and emails that day. I missed this. I'll be honest with you. I missed this opportunity. Do I need it to be watching it every second? No. But when the market opened and I first looked at it at the beginning of the day, I said, you know, this is looking like a good opportunity to do something on this CarMax position. But I missed it. Before the market closed, I was still on the phone, and then I had to plan for the open discussion webinar, so I missed it, and then this happened. So I missed an opportunity. But you know what? I'm quite okay with that because I'm still expecting this to come back up. This decline over the last 2 days, we just know what happened. That stock, to me, my expectations of it are still bullish, and I still think it's going to come back up. So I should spend more time doing it, but that's not my job. My job is to teach customers, be on the phone, and handle emails. I think really you can get away with maybe only 5-6 hours a week looking at your positions. I honestly think that for the radioactive trading technique. But I only spend about 2 or 3 total. And yeah, I missed some opportunities. Oh, Mark L. wants to know, okay, in the search I've seen 6-month puts and sometimes 1-year or longer puts using the leaps. If you selected the 1-year put, wouldn't this give you more time to do the income methods and therefore be preferable? Yeah, that's discussed in the blueprint. Going longer term, your cost per day is less. Your upfront price is higher. You're adding a lot more into the position up front. But if you consider it for the longer term, the price per day is always lower if you buy the put further out in time. It does have its advantages. And that doesn't mean you're going to be in the position for the entire time. You do have a longer time frame to do the income methods. But it's personal preference. Some of those times when I enter an RPM for income, I'm only looking at it based on, being in the position maybe for 3 to 6 months. No more than that, 3 to 4 months even. Mark wants to know, will income method number 4 still work if the stock gaps up well above the put? Yeah, I've seen that before. It's still okay to do it. I did have some regrets with the silver wheaton position when I wanted to do income method number 4 when the stock was trading at the put, but it still worked out for me when I let it go 3 or 4 points above the put strike price, even on a gap. And the great thing about the gap is when that happens, Mark, if it gaps up and jumps up 2 or 3 points well above your put strike price, or maybe even 5 or 6 points above that put strike price, implied volatility is going to spike too, so that can actually work in your favor. Richard, complex question. Complex question, and the short answer is yep. I'm going to try to not be arrogant on this, but I have to state it this way because it always kind of makes me smile. I know a lot of you are experienced options traders. Some of you are more experienced than me. Got to be honest with you. I know you've been trading for longer than I have. Some of you have done some of the more elaborate strategies that I never traded myself. Richard asked a question. Mike, have you ever looked at buying the put that you would normally buy in an RPM, then selling a lower strike put at selling a lower strike put, getting a sign in the stock, and now you have your RPM in place? Yes. And why I say I'm not going to try to be arrogant about this, but what I was referring to is that all of the questions that you have, not you, Richard, personally, but everyone who's had a question of, hey, Mike, is it better to buy an in-the-money long call and the put I was going to buy instead of buying stock to save capital? Is it better to just buy the call first and then look to buy the put? Is it better to do a covered call first, and if you don't get a sign, then buy the put if you still have the stock and the call expires? Is it better to get into the RPM using a naked put or the calendar put spread, as Richard asked, instead of buying it outright? Every question you guys have, I did the same exact process when I first started working with Kurt. When I first got my hands on the blueprint after I attended some of his webinars and started joining the joining his presentations to show the PowerOptions tools and how they could be used, I went through those exact same scenarios. Let's go back to the married put search quickly, and I'll show you why eventually I stopped looking at this calendar put spread idea. I actually want to go back to that other search we had that only had the 2 positions. And these might not be the best premiums, but let's take a look. Penn West Energy, risk of 6.5%, pretty high. 210, buying the stock at 28.20 and selling the September 30 put. What about if I just bought the September 30 put and either sold the slightly in the money, let's say maybe March 28 put? 29 put even, or the March 28. What would that look like? Let's simulate it. Let's go to the profit and loss chart. All right. There's our RPM. Let's get a view. 6.5% at risk, infinite upside profit potential. I started evaluating this. This was my first concept. It made perfect sense to me. Why don't I do that? I'll sell a put either at or just slightly in the money. Therefore, if the stock gets put to me, I have the stock at a lower price, probably would only have a 4% risk in this situation and have the married put in place. Well, let's start with, all right. You can tell it's getting late. I'm selecting calls and I'm selecting puts. Let's start with the at the money 28. Good premium, 65 cents. If we put the stock, our cost basis will be 27.35. All right. Let me sell one contract. There we go. The problem I ran into with this scenario is you have to be very careful with how you manage this position. By itself, this is diagonal calendar put spread. This looks like a reasonable position. Maximum risk is 325 if I only did one contract of the long put, one contract of the short put. 11.7% maximum profit. That looks good percentage-wise, but yeah, it's $38. All right. Keep in mind, if I can only afford to buy 200 or 300 shares, I'm only doing 2 puts and 2 short puts, for example. Okay? Where's the problem? If I'm right and the stock drops just below 28, and stays there on March expiration, maybe at 28.50, 27.50, or maybe 27.20, fantastic. I get the stock put to me at 28, and my cost basis is now 27.35, so I've got a much lower risk because my put's already in place. Well, what if the stock starts to drop down below what would be the break-even of 27.03 in this scenario? Now you got to think, what do I need to do here? Do I need to buy to close the short put I have open that's in the money now, and then sell to open the 27 put? Do I need to roll it down? Do I need to adjust it further? Well, it's going to cost you more to buy back the 28 put. If the stock's at 27, it's going to cost you $1 to buy back that put, and then you've got to hope that you're getting at least 35 cents for the new 27 put. Or just let it get put to you. But what happens if the stock's at 25? Yeesh. Well, now I own stock at a little bit lower cost, only 6%, but it's way down at lower risk. It's way down at 27 or $25 per share. Am I expecting it to come back up? Problem I faced was on the upside. You sold a 28 put for 65 cents in this scenario. Once the stock hit about 28.65, you have to scramble to buy to close this put and buy the stock, because if the stock keeps moving up to $29 or $30, eventually you're just losing money. Your risk up here is so high, percentage-wise, you're just losing money on that position. You've heard Kurt in some of these webinars, Richard, say he's not good at timing trades. You know what? I'm not really that great either, in the sense that, you know what, if I did this, if the stock started to move, I got to scramble to buy it. I got to scramble to roll it. The minute it goes above that break even, I have to buy stock now, because if I let it go up to 30 or 31 per share, which I'm expecting to do, here's the real trick with this. When you're thinking about entering an RPM, what are your expectations? Over the next 35 to 45, maybe 60 days, I'm expecting the stock to go up 5 to 8%. Does this setup match that? When you enter this by using the calendar put spread, what are you saying? You're saying in the next 30 to 45 days, I expect the stock to drop slightly or be trading right at the short put strike price. Then in the consecutive or the next following 30 to 60 days, I expect the stock to move up 5 to 8%. If you can do that, Richard, if you can pick stocks that will follow that pattern where in the first 30 days it's only going to drop slightly or just a little bit below or be right at a short put strike price you want it to sell, but the next 3 months after that or the next 60 days after that it's going to be trading up 5 to 8%, you're a better trader than I am, and this might work out for you. I am not that good. I cannot pick and say this stock I know, pretty sure it's going to drop down or hover around this price in the next 30 days, then in the next 60 days after that I expect it to move up 5 to 8%. Hey, if it did, yeah, you could get the stock for a lower price now, and I already have the put in place when we convert this. What would it look like if the stock was down at, let's say, $27.50? You're forced to buy shares of stock at 28. Your cost would be $27.35. So let's add stock, 100 shares, $27.35. Right. So then going forward, after that, over the next 5 or 6 months, hey, you've got a 4% risk instead of that 6% risk we saw originally in the RPM, and you still would have, after 24 days, you'd still have to September expiration to make other adjustments. All right. Well, yeah, Richard, if the stock continued to go up after this, sure, you can do the other income methods at that point, yeah. All right, Roger wants to know what would happen if KMAX would have a takeover rumor and their stock would gap up to, say, 60 overnight. Oh, I should be so fortunate. I'm liquidating the position. You know, the stock moves up to 60. Let me simulate that. What would that look like? Let's go back. Let me close this down. Let me go back to the portfolio. We're going to run the what-if scenario. Okay, I'm in my CarMax position, hasn't moved. I haven't sold the call yet, for example. I'm just looking at the static married put. Profit and loss chart here from my portfolio selection. What am I going to do? Did you say tomorrow? Let's say 2 weeks from now. All right? Let's say 2 or 3 weeks from now, someone comes out and says they're going to buy CarMax, and the stock rockets up to 60. So I'm going to run my what-if scenario. Stock trading at $60 on, what is today, the 23rd. So let's just say St. Pat's Day on 3/17, all right? Let's go about 2 weeks out. My profit on 100 shares of stock, my profit on a $3,800, or let's just call it a $3,900 investment, would be $2,113. Could I adjust the position at that point? Yeah. I could try to do an income method number 4, roll up to maybe the 60 strike put or something along those lines, guarantee myself maybe a profit of, let's say, maybe $1,750 or maybe $1,500 instead of the full $2,130 if I'm expecting it to go up further. Ernie has had this happen to him in the past. I cannot remember the stock, Roger, off the top of my head, but he was in an RPM recently. I could probably go into the Fission portfolio and look at it. And by recently, I mean the last 8 or 9 months. And he had that happen, and as soon as he saw the buyout and he had the profit, it matched his goals, and he closed. He just liquidated it. And I think that's what I would do in that rough scenario as well. In that scenario, I think I would do that too. Tom wanted to know, have you ever used a synthetic stock when trading a radioactive put? No. Most of the reason why, Tom, is that at the time when I had customers asking me about this and I was evaluating it, in that retirement account, I also couldn't sell naked puts. You know, the synthetic of the long stock would be to sell a put and buy a call at the same strike price. I couldn't sell puts at that time without, actually I couldn't sell puts at that time in that account, so I didn't look into it. For a fact, I know of at least 4 customers that I've talked to in the past year and a half, maybe 2 years, who have tried this with the radioactive trading technique, and I know at least 3 of them abandoned it after 2 months. I don't know why. I'm not sure why they abandoned it. They just went to straight married puts. And the other gentleman, the 4th gentleman I know who was doing it, I haven't talked to him in probably 5 or 6 months, but he's still using the PowerOptions tools, and he's still actively using them. I just don't log on to his account to see when it's done. Roger, what would happen to the put in that scenario? You kind of see it here. It would essentially go worthless. I had a July 37 put on CarMax. If the stock was trading at $60, I'm expecting it to be worth about $2. That would be about 2 cents. Okay, that's using the Black-Scholes pricing model. You might have an ask price of 10 cents on it if it's still listed, but it's gone to 0. Okay, so just sell to close the stock at 60, and then maybe just let the put go away because it has no price there. All right, that's what would happen to that put in that scenario. All right, Mark wants to know. Mark T tells me not to laugh. Okay, I'll be serious. Why not set it up, say, 365 days out, and after it goes up a little, use income method number 3 to adjust back to the 200-day RPM setup? Okay, I'm not going to laugh, but there's something unique about income method number 3 that I wanted to bring to your attention, and we started to do this at the beginning. But income method number 3 has a little trick to it. Even with that approach, Mark, there's a little trick to income method number 3 that you always want to make sure that you know ahead of time, okay? Let's go back to Talisman Energy. And later on, Mark, I promise, I'll run some scenarios with this using the historical tools to see how that would have worked. I think that would work. I think that would be right. If I bought the LEAP first, the 2012 LEAP option, and the stock moved up my 5 to 8%, I think I could sell to close the LEAP and say buy the September, or it would be closer in, wouldn't it? August, maybe June, or August or July. Buy the July put, and I think I'd get some premium off of that. And that might still work out closer in, but I'll have to run some scenarios actually to do that. That's a good one to write down. Cut from LEAP. Well, these are all good questions. Don't get me wrong, ladies and gentlemen. I don't want to single that out. These are all great questions, but I've never actually run scenarios with this. Cut from LEAP to 6 months after stock goes up. All right? I'm going to do that. I'm going to run some scenarios on some positions, see what we look there. Okay? Well, the first thing I want to do, let's go into Talisman, and let's go to that income method number 3 position. All right? Oh, come on, stop that. There we go. Let's open it up full screen. We had an income method number 3 opportunity. Remember, this is the one that went up 5%. It's trading at $24.49. Could sell to close my 25 put, my July 25 put, and buy to open an April 25 put, and this cuts my risk down to 3%. Not really a half. It only adjusts it a little bit. Now, the trick is with this one is I did lower the risk, and I still have the unlimited upside, and I can still continue to trade it. But this isn't a great example. Let me simulate it using income method. Let me simulate this using a March option instead of the April one that came up on the results, because I want to show something that I've always come across that kind of bothered me about income method number, not bothered me about income method number 3, but made me hesitate on some choices. Profit and loss chart. Okay, we're going to do an income method number 3. We're going to use the 25 put. We're going to roll to the March 25 put. So I'm going to set it up here, simulate an income method number 3. I've already got the July 25 put purchased. I'm going to add that back in. July 25 put, and I'm going to sell to close it at 210. That was the natural ask bid price. My apologies, natural bid price. And then I'm going to simulate buying the March 25 put for 135. Man, that's a wide bid-ask spread, isn't it? Jeez. It's interesting how the calls only, this kind of shows you a little bit of the, well, no, I guess that's right. It's a little bit wide there. All right, anyway, March 25 put, we're going to buy 1, and we'll leave the natural ask at 135. Okay, I could probably get in between that a little bit, but that's all right. Now, what do I have now? Great, I reduced my risk. My maximum risk is at 1.8%. Okay, so the most I can lose now in the position is 1.8%. That did solve the problem, but now I only have 24 days for the stock to continue to move up. Okay, now what would happen in this scenario with income method number 3? Let's say if the stock moved up to $25.50, moved up another $1 on March expiration, 3/19. Okay, let me just take a look there. All right, so my total expected profit and loss, and this includes both, of course, but it's adjusting it accordingly. So really, if the stock was up at that price, after doing this income method number 3, I wouldn't have a lot of gain on the position. Why is that important? Well, because that goes back to our SIGA model. Right, if I did this income method number 3 position, generate some premium, lower my risk down to 1.8%, but now in March, if the stock's trading another $1 up at $25.50, I don't make a lot of profit. What you'll notice when you evaluate income method number 3s is if the stock has moved up as you expected, you may be better off liquidating now. In this case with Talisman, taking the guaranteed 1.4% after 15 days off of the table, because with this position it can still go down to a full loss of 1.8% in only 24 days. Now this is a different scenario. I understand that, Mark. What you're talking about is much more long term, and I think it might work out to be a good approach. But I'm going to run some scenarios with the historical tools to look at that, give it to Kurt, and hopefully he'll let me post a blog article on him, RadioActive Trading there. Or he'll do it himself, however it works out. But that's the one thing I wanted to mention when we were talking about the income methods before with the SIGA model. A lot of times when I'm looking at this income method number 3 on this position, what I have to evaluate is, you know what, I might be better off just liquidating right now, taking the gain, if I'm not expecting much more of a move on the stock in the next 24 days, rather than risking this, taking this winning position to a potential loss of 1.8%. Because at this point, if I reach March expiration, it's trading at $25.50. If I have to go out now and buy another July put or a September put, I'm going to take this risk probably up to 6% or 7%. Remember, we started off with only 4.9%. That's a trade-off. But yeah, with this starting in a year and rolling in 6 months, I'm going to evaluate some positions that have moved up recently, Mark, take a look at them in the historical tools and see what they do. Now that being said, Mark, you know my schedule. I wouldn't expect you to hear from me until possibly Friday. I don't know how much time I'm going to get to work on it with other projects I have right now. And webinar tomorrow as well, a couple of coaching sessions, and some other projects I'm working on with the programmers there. Okay? All right. Yeah, Mark, what I would suggest is look for a stock that you've seen from, let's say, January to February now that have moved up maybe 5 to 10%. And we know we have a couple of stocks that have done that, but just from January to now that have maybe moved up maybe from January expiration till now that have maybe moved up 5 to 10%. And what I would run in the historical tools is look for positions, look for original married puts that match sort of my criteria on that stock on January expiration, but had leap options. So now we got to narrow it down to just the leap options, which is about 1/3 of the optional stocks. But I'll look for the ones that had leaps, and then I'll see what would have happened now the stock moved up 8% if I rolled my 2012 leap back to a July leap or back to a June leap. All right. Let me navigate over to our slide presentation. I think I've answered all the questions. I might have accidentally deleted one, so if you're still online, you asked a question, you didn't see an answer, send it back to me. But I'm going to get close to wrapping up because we are at 10:45. we knew we were going to go over. I should always just keep scheduling that in with these presentations, but hey, it's great. We still have most of our attendees with us. I know some people had to leave. Fantastic. All right. The PowerOptions services, Power Suite of Tools, 20-minute delayed is $59.95 per month or $600 for the year. We offer a real-time service. Every time you run the search, refresh the page, you get the numbers at that very instant. That's $79.90 per month or $800 for the year. The historical data is an additional cost. It's not included with the real-time or the 20-minute delayed. You can get a 3-month access to the historical suite of tools for $99.95. If you already have the real-time service, you can just upgrade to the professional. It's actually cheaper. It's only $99.99. The professional level of service includes all the real-time plus the access to the historical suite of tools. Okay. So I just want to do that. Now, if you think of any questions later on, please send me an email to support@powerop.com. You can also call us toll-free at 877-992-7971 during market hours. Or you can reach us at 302-992-7971 if you live outside the continental U.S. Of course, there are contact links on every page. This presentation is recorded. Will be available hopefully tomorrow, maybe after 1:30, maybe after 2 o'clock in the archive section we went to earlier, and it'll also be available in the archives on RadioActiveTrading.com. Okay, Mark says thanks. Joel says thanks. Thanks, Joel, for joining me. Mark, thanks for the questions. Larry says, your answers created several light bulb moments for me. You learned a lot. Excellent, Larry. Remember, this will be archived, so you can reference that later on at any time, and feel free to give me a call tomorrow or send me an email if you think of any questions you had of what we discussed tonight. Richard, it was great seeing you. Rick, it was great seeing you too. I hope I answered your question. If not, I'll look at your email that you sent before the webinar, and I'll send a reply to you as well with my thoughts on the question you asked that you had sent to me an email before the presentations. Thank you for the questions. Mark L. and Mark T., thank you for the questions as well. Gary, I didn't see your name come up originally. I didn't look at the attendee list, but hey, it's great to see you online as well. Thank you for joining us, Gary, and I hope to see you at some of our other presentations coming up. Chuck, hey, it was great seeing you, Chuck, as well. Thanks for coming. Anthony as well. Thank you, guys. Look forward to seeing you. Remember, Friday at 4:30 p.m. Eastern Time is just the basic open discussion. Feel free to come with any other questions you have, 4:30 to 5:30 p.m. Eastern Time. Tomorrow at 12 noon, of course, is Kurt's standard presentation, the radioactive trading presentation. Ladies and gentlemen, have a fantastic evening. Thank you for joining me for the Power Options for Radioactive Traders Part 5 open discussion presentation. Look forward to some of our other educational series that will happen in the evenings going forward. And I hope to see you all there for those as well in the next couple months. Take care, everyone. Good night.